Hello, everyone. Welcome back to another update, a macroeconomic update here. We took a little bit of a break 2 weeks ago when we talked about more about fundamental analysis, especially with regards to assessing earnings quality. And today we're getting right back where we left off in the prior video, just talking about several important updates on where we are in the macro picture, where stocks are, where economic data is, and what the Fed just did. So the title of this webinar is similar to the prior ones, which is that stocks continue to defy the Fed and economic data. Will it hold? Part 19. And that's kind of a joke because I've been talking about this for months now. My call, dating back to September of 2022 has been weakening economic fundamentals, increasing likelihood of recession. And since then, stocks have really just levitated. It went down quite a bit in October of last year and then bounced back, and it's now higher. So I'm just kind of keeping myself honest here and giving you a little bit of an update on how the market has gone since my bearish call. I made that initial call in September of last year, and since then, the S&P at that time was about 4,000, and today it's at roughly 4,100. So a little bit higher than when I started to talk about going defensive, but not much higher. So here is a couple of important updates on where we last left off. So the FOMC just announced yesterday that they will be hiking another 25 basis points. That takes us to 5 to 5.25%. And the meaningful change in the most recent, press release was that they are signaling a pause and evaluate phase now. So they will not likely be increasing further until they get more data on inflation. So it looks like we're going to be pausing here for a bit and seeing where things start to go from here on out. This is basically the highest level of interest that we've had since 2007. These actions have inverted the yield curve by the most amount in 40 years. If you look at the 2-year minus 10-year yield, this is the deepest inversion we've had in quite a while, dating all the way back to the 1980s. Now, the other part of it, which is obviously more important, I think, than even what the Fed is doing, is how earnings are shaping out to be. And so far, Q1 earnings have actually beat by a broader margin than in the past 5 quarters. In fact, it's tracking well above the 5-year average. And by that, I mean what percent of S&P 500 companies are beating earnings and revenue expectations. And I'll show you a couple of charts with regards to that. However, despite these broad-based beats on earnings and revenue, growth continues to wane. So growth continues to decelerate into negative territory now, despite these beats here. And that's why I think the earnings and revenue beat are actually less important than the rate of change and the trajectory of earnings, which continue to be negative. And I'll show you a chart of that in just a minute here. Meanwhile, market interest rates such as the 2-year yield and even tips, they don't seem to agree with what the Fed has been doing. And this has been going on for not just recently, but now for almost a year, where the 2-year yield is almost 80 basis points, 80 or more, lower than the Fed funds rate. So my interpretation of that is that not only do investors believe that the Fed is going to cut over the next 2 years, that's probably likely in my view, but it also means that the market doesn't believe that rates should be this high. Remember, the market is continuously reevaluating economic fundamentals and the supply and demand for credit, and prices credit accordingly. And that is usually the best rate to, do the best in terms of balancing inflation control with growth. And remember, the Fed has a singular mandate, which is that they need to get inflation under control while maintaining full employment. And since we're at full employment, the Fed doesn't really have a growth mandate, so therefore they go after inflation without anything else in consideration. And so now, we're at 5.25%. The 2-year yield says, hold up, we don't think rates really should be that high. We think they should be at 4.1%. And so that is a very wide spread between the Fed funds rate and the 2-year yield, which is one of the deepest inversions now in quite a while, dating back to 2007. So again, these are all charts that we'll walk through here. And we also see multiple banks failing. We just saw PacWest plunge by 50% back-to-back days here. So this is in addition to several other high-profile bank failures. These aren't major systemically important banks, but they are big enough to have an effect when you combine them together. And this is happening mainly due to very large asset liability duration mismatches. So because people are pulling money out and at the same time they have a lot of held to maturity losses, due to interest rate risk, they're forced to, sell those securities at a loss in order to meet withdrawals. And this is now happening one after another. So now there's increasing fears of a contagion that might start to affect bigger banks. And I think the two that I have in mind are U.S. Bank and Bank of America. These two banks are quite large, and they do have quite a high percentage of losses on their held to maturities portfolio relative to their Tier 1 capital. So that would be very, very, important to keep an eye on. I don't think that they will fail, but I do think that there could be a major problem that arises because of this. And we're starting to see these dominoes fall one after another, as it began with Silicon Valley Bank just over 2 months ago. Meanwhile, depositors, they continue to pull billions of dollars out of banks each week. So this is, I believe, going to have sustained impact on banks. Because now with the Fed funds rate at 5.25%, who in their right mind is keeping their money at normal depository institutions? Because they still don't pay a lot of interest. Even today, most banks, both regional and national, are not paying very much in interest on deposits. Even if you have a savings account with many of these banks, they still don't pay much. So who is keeping their money there? And that's why, depositors continue to pull out money, both because of, all these headlines showing, bank failures, and because they can earn 5% from, a typical money market fund. So why would you keep money in a bank when you can earn 5% risk-free in a Treasury money market fund? So all these events combined, I believe, are a major negative for credit creation. So again, I believe the Fed has gone way too far in rate hikes. But again, I don't make the rules. We're just here to understand what's happening and react accordingly with our portfolios. But the Fed has been hiking into a slowing economy, and with inflation clearly coming down. The rate of change is undeniable, that inflation has come down, even though it stays high in certain pockets of the economy. The fact is that you can't control every type of inflation. It's just not possible. And the Fed funds rate is like a giant hammer. And what you're trying to do is perform, targeted surgery, which you really can't do. And so the pace of depositor withdrawals might only accelerate in the coming weeks and months, as 5% rates entice millions of savers to pull funds from checking accounts and go into money market funds. So I believe that the banks are going to be under pressure for the foreseeable future, even if the Fed cuts interest rates, even if they cut to 4%, which is not likely in the short term. Even if they do, 4% is still better than what you're getting at most banks. So I think banks are going to remain under pressure for some time. So let's switch over to earnings, and this is the beat rate. So we're taking a look at what percentage of companies within the S&P 500 have beat earnings and revenue. So earnings is on the left side, revenue is on the right side. So you can see right here, as of Q1, so far about 2/3 of all S&P 500 companies have now reported earnings, and 77.6% of the companies that have reported have beat their Q1 expectations. And that tracks well above recent trends, really going back to the first quarter of 2022. And it is tracking right pretty much at the 5-year average, just slightly below. So that's better than expected. And that's the rate of improvement has clearly shown itself. We dropped all the way to 70%, and now we're up to 77.6 on the earnings side, and then on the revenue side, 74.3%. That's clearly much better than the 5-year average. So I actually believe, especially for profitable companies, revenue growth is more important than earnings growth. That's just my personal viewpoint, because that tells you the state of demand for your products, right? Revenue tells you the demand for your products, and earnings tells you, how efficient of a machine that you are. So the two together tell you exactly who you are as a company. But, as revenue, accelerates, that's very, very bullish, because that means that demand is very clearly there, for your products and services. So, Q1 was not as bad as feared, and it was better than how it, ended up being for, over the past several quarters here. However, this is the big but. The growth rates are continuing to come down. You can see earnings now on a year-over-year basis are now negative, at negative 1.6%. That is an improvement versus Q4, but it's not much, and it's well below the 12-quarter moving average. You can see that revenue actually still is positive, but you can see that there's a clear deceleration of revenue growth. We're at 4.1% here. That's well below the 12-quarter average, and trending downwards versus recent quarters. So I believe that these numbers are going to continue to track down based on the fundamentals of the economy that I'm seeing here. And this is a look at a picture of bank credit versus deposits. So again, another reason why I think earnings and revenue are going to come down is because I think that there's going to be significant pressure on credit creation, particularly because banks are under pressure right now. So here's a chart of bank credit versus deposits. So credit is on the asset side of bank balance sheets versus their deposits, which is a liability on bank balance sheets. And you can see that for the first time ever, really, since we started tracking this data, deposits exceeded bank credit. And now that's sort of normalized here, and it's actually slightly below. But we saw, quite a dramatic reversal of the usual relationship that these two have. Usually assets exceed liabilities, and they still do, but usually bank credit, exceeds deposits by a comfortable margin, as you can see throughout most of this history here. And this is a linear chart, but if I showed it on a log basis, you could see that continued even during this period here too. But we saw, a dramatic reversal of that in the wake of the 2020 COVID response, which was, the most radical monetary policy in U.S. history. That sent M2 surging, deposits soared well beyond bank credit, and now that's coming down as depositors start to pull billions of dollars out each and every week. And here you can see a little bit, I've zoomed in over just the past year, ever since the Fed started raising interest rates right around a year ago. You can see the systematic and slow and steady decline in deposits. And that really has started to accelerate ever since the demise of Silicon Valley Bank and Signature Bank. And I believe that's going to continue. This is updated through the end of April. So it'll be very interesting to see the next update in the wake of these big drops in PacWest shares and other banks as well. So I think that this is going to continue to come down. So banks are going to remain under pressure for as long as the Fed is at an interest rate significantly higher than what banks are capable of paying right now. And again, history has shown that, whenever the Fed forces inversion to this degree, something has broken. Something in the economy has broken. And I think right now banks are the leading contender for that, being the catalyst for, recession to really truly accelerate. So here we see the spread between the Fed funds rate and the 2-year yield. Again, we're at minus 81 basis points. That is very deep inversion. Now, it's gotten worse before, like back here in 2007, 2008, where the Fed was very aggressive. And the 2-year said, hold up, we don't agree with this at all. We think this is way too restrictive for the economy to handle. And therefore, the 2-year never followed the Fed funds rate, by nearly as much. And that's what caused this very deep inversion. That's what ended up breaking a couple of things. And, then we all know what happened after that. But we're kind of repeating that we're sort of repeating that again this time around. We're not quite as deep, inverted as we were in 2000, 2007, but still, this is not anything to ignore. And this can really get to -1 or below in a very quick and very short amount of time if the 2-year yield suddenly starts to drop, which it actually has, this past week. And this is as of, 4:30. So I do believe that the number has gotten even deeper inverted as we speak, just 5 days into the quarter, into the month. And look on inflation. See, the Fed continues to think that inflation is way too high. But again, I think that they are operating on significantly high latency because the CPI is a lagging indicator. You can see that the backlog topped out 6 months in advance of the CPI topping out. And it's now leading to the downside. And you can see that the CPI is clearly headed down. 5% is not static. I think the real rate of inflation is much lower than that. And I'm sticking by my view that we will be below zero at some point within the next, 6 to 12 months. Not many people are saying that, but I believe that. I really do believe that. As long as backlog remains deeply inverted, which it is, it's kind of hanging out here, even though it's bounced off the lows here. It doesn't really matter. As long as it's below 50, that means that the index is in contraction. And therefore, CPI will continue to come down each and every month overall, on average. So again, I think the Fed has made a mistake by looking at this data and not reacting to more real-time data. And speaking of inflation, what's more real-time than actual markets? So here we see a chart of crude oil futures, and you can see that number has come back quite a bit, dramatically from the highs. It reached almost 130 per barrel. It's now down to below 70. That's like a 40% correction from the highs. And even though that high was exaggerated, again, we're pretty much right in the midst of where oil normally trades at over the past 20 years or so. Now, could we go lower? Sure. But I mean, this is not an abnormal inflationary chart. Same thing with wheat futures. Here's a chart of wheat. Really nothing to see here. These spikes and drops happen all the time. Again, that's mainly due to supply-demand mismatches. Remember, if there's a drought or a hurricane that knocks off, that destroys crops, wheat futures surge. That's really nothing to do with monetary policy, and it really shouldn't be addressed by the Fed at all. That's just a supply disruption, which always inevitably comes back and reverses itself out. May take 6 months to a year, but again, this is just a supply-demand mismatch. So if the Fed is basing its decisions on these types of moves up, I think that's a mistake. But here we see, wheat futures right back to where they've pretty much traded for the past 20 years. Here's lumber. This actually grabbed many headlines, back in 2021 and 2022. This is way down now. So it's essentially back to where it's always been, dating back to the 90s. So again, these are not very inflationary charts. Natural gas. This is something everybody needs and uses it, throughout the winter. We're back to 90s levels prices. Again, there's really not much here. So again, if you're looking at the CPI and you see that the CPI is high, again, that's because there are certain parts of the market that are still high, namely housing prices, rents, and used cars, and electricity prices. They remain very high, which is why the CPI is staying elevated. But my opinion is that the Fed funds rate is just a one-size-fits-all hammer that will eventually crush these inflated areas of the economy, but at a tremendous collateral damage. Because remember, if you're trying to tamp down certain aspects of the economy in terms of prices, you're also going to hit everything else with it. And that's exactly what's happening. Here you can see the Philadelphia Fed Manufacturing Index. This is at recessionary levels now at this point. Anytime it's gotten below a negative 25 reading, that's had a 100% track record at predicting a recession. 100%. You can see every recession is shaded in gray here. Every single time we've gotten this low, we've had a recession. And with no false calls either. We've never dipped below 25 and not had a recession. So again, folks, this is very, very clear data that the economy, especially in the manufacturing sector, is in recession. Now, unemployment remains very low. And this is what the Fed is hanging its hat on, saying that, look, we've got a dual mandate. Keep employment high and keep prices stable. So since employment is high, all we're doing now is going after price stability. So they don't really care about growth. That's not a part of their mandate. But if you look what's going on, slowly but surely, permanent job losses are silently mounting. This is, and we're going to get an update on this tomorrow. So I would keep a very close eye on this number. This is published again by the BLS, permanent job losers. This is the total number of jobs that have been canceled, right? So permanent jobs that are permanently canceled. And this number has silently but surely crept up. Now, nobody talks about this number. I don't really see this discussed very much. Everybody loves to talk about the unemployment rate, but nobody talks about permanent job losses. So this is the other statistic. And look what happens. Every time it crosses above the 30-week moving average, right, for example, that has been the confirmation that a recession is getting going here. So it hasn't happened yet. However, this could be an aberration because the moving average is being skewed by the dramatic move that we saw during COVID. And that was sort of an unnatural recession. That was a forced recession due to lockdown. So the moving average is skewed a little bit to the upside. So if you were to go based off of 2019 numbers, we've already, crossed above the 2019 30-week moving average. However, I would still wait for a little bit more confirmation. If we get another month or two of this going up, I would say that, the last shoe to drop of the economy is usually unemployment. And now that's starting to happen as well. So that's what's going to really crush the consumer economy. And that's what will finally bring earnings down significantly. So again, what does this all imply for stocks? Look, if the market was priced for a recession, I'd be tooting a different horn here. But we're now at well above 18 times, forward earnings. And if you look at it, the last time we had a Fed funds rate this high, and this number is now going to be 5%. It's still, at 4.75 here on my chart, but we're at 5% now. The last time we had 5% interest rates, the market was at a PE of 14 to 15 times. A 14 to 15 times PE the last time we had 5% interest rates, and now we're at, well over 18 times. So this is not factoring in recession at all, in my viewpoint. I think the market is pricing in a soft landing, if anything. And if you compare growth rates, for example, this is earnings growth year over year on forward growth rates, that is forward earnings expectations. In the last time we had 5% interest rates, we had a 15 PE on the market, and we had about 5 to 6% earnings growth. Look at where we're at right now, minus 3.6% year over year. So, we're at a higher PE and lower growth rate, versus the last time we had a 5% interest rate environment. It's very difficult to sort of explain this. You can justify this multiple if we had growth. You could justify the multiple if fundamentals of the economy were strong, if manufacturing was an expansion. But you really can't justify an 18-19 multiple when we have earnings contraction and the trend rate of change is down. And we all know what the Fed is doing. They're committed. I mean, the Fed is very clear, and they've been committed to removing liquidity. M2 money stock is dropping like a rock here for the first time in 60 years. They are committed to removing liquidity from the system while keeping interest rates high. So even though they're not going to raise much more, in fact, they're probably not going to raise at all, they will stay at 5.25% for some time before they start cutting. So this is a restrictive Fed. I believe that they want stocks to come down. Jay Powell doesn't say this explicitly, but I believe that's what he wants to do because he thinks that stock prices coming down is the way to ultimately bring inflation down permanently. And again, the Treasury yield curve is warning of recession, as we saw in the prior chart. Just like the 2-year minus the Fed funds rate, the 2-year minus the 10-year is also deeply inverted. And there's also early signs of steepening. Remember, when it gets inverted, that's a very early warning sign of recession. But when recession has arrived, what happens? It re-steepens quite dramatically here. So right before the recession is just about to get going here, it crosses back above zero. So it's the inversion that gives you the early warning shot, and then the re-steepening gives you the alarm, sounds the alarm that something is about to happen. So we haven't gotten that yet, but I believe that we are in the early stages of a re-steepening, as we started to see here. Ever since the collapse of Silicon Valley Bank, something has shifted. And I think that this is starting to move up now. So I believe that the moment that we start to cross over, minus 25 and then towards zero, I think that is the final sort of warning shot. And I believe that we're going to be getting that in the next couple of months here. You can see that housing prices are cracking. This is, again, what the Fed wants to do. But all this, weighs on earnings because remember, all these things are interconnected. When housing prices go up, people have a lot of equity in their homes, and that actually, contributes to the wealth effect, and that ultimately boosts up revenue and earnings of companies. And when housing prices drop, that starts to weigh on, companies that are not even connected to housing. So, this is all a part of the wealth effect that weighs on earnings when things start to head south. And again, Chicago PMI, I like to look at this as in terms of its correlation to forward earnings growth. And as I've been saying, this deep correction in the Chicago PMI, it's still negative. It did bounce back when they reported the update just 2 weeks ago. It's at 48.6. That was a pretty strong bounce back. I must say that I was a little surprised by that, but it is still below 50, which means that we're still in contraction. And we've been in contraction now for almost, I believe it's almost 8 months now. So the Chicago PMI has been in contraction well below 50 for 8 consecutive months. So again, the longer it stays below 50, the further the S&P earnings growth has to fall. So we're getting that now, as we see with the Q1 update here. We're basically flat year over year as of Q1. And I believe that we're going to be negative by the time we're done with this year. And as you can see, analysts are reacting to that. They continue to slash earnings estimates for the S&P just about every month now, and we continue to see that. Now, I will say that the rate of change has slowed. So I think that, because Q1 expectations beat the very depressed expectations, we may see a pause in the earnings, in the rate of change in earnings cuts So we may start to see this number stabilize for a bit. But I believe that number is going to continue to drop and reaccelerate to the downside in just a few months as we move closer towards the end of Q2. But we'll see here. So again, to summarize, the primary takeaways: Chicago PMI, ISM manufacturing, Philadelphia Fed. All of these manufacturing gauges are all in deep contraction and have been there for more than 6 months. We have a deep yield curve inversion, early signs of steepening. The Conference Board leading economic index has been in deep recessionary territory now for almost 10 months. S&P revenue and earnings growth continues to wane into negative territory, into negative year-over-year growth. That trend, I believe, is going to continue. ISM backlog indicates that the CPI will continue to come in lower. Key commodities like oil, wheat, natural gas, lumber, they're already well back within their normal ranges. There's just no signs of inflation there. And the Fed is hiking and now continues to remain aggressive into a slowing economy. Meanwhile, banks are coming under extraordinary pressure. Full extent of collateral damage of an aggressive Fed is still unknown. So banks are coming under pressure not only because there's a loss of confidence in liquidity, but also because there's no reason to keep money at banks anymore. So even if there was no loss of confidence, even if there's no crisis of confidence, I still think that banks would still be under pressure because there's no reason to keep money in a checking or even savings account that yield less than 25 basis points right now, which is still sort of the national average for banks, when you can put it into a money market mutual fund and earn 5% risk-free. So, in my opinion, again, is that the 2-year yield believes 4% is the optimal balance between inflation control and economic growth, and that we really should be listening to the market more often. But here we are at 5.25% on the Fed funds rate. I believe that this is going to lead to something breaking in the economy, and that will set off a chain of sort of a domino effect of one thing after another going down. We're already starting to see that with a couple of banks failing in February, and now many more are under severe pressure. And it's just not stopping. And I believe the next one could be U.S. Bank and possibly, Bank of America. So I would love to, be sure to keep a very close watch on those two. And earnings estimates continue to come down. They continue to trend negative. And yet, despite all of this, the S&P still trades at 18.5 times forward earnings, a forward PE of 18.5. This is highly elevated relative to its zero or negative earnings growth, high Fed funds rate, and high likelihood of recession. So my prescription here, my only takeaway here is that I would remain defensively positioned. Own 3-month to 1-year treasuries. They offer tremendous value right now, I think. Earning 5% risk-free, the Fed is basically begging you not to take a risk right now. And I think that's a good bet to take. It's a great deal to take. And then on the equity side, I would be defensively positioned. So Zacks earnings certain proxy type companies. These are high quality, recession resistant businesses that have very steady earnings growth that are uncorrelated to the business cycle. Those are the types of companies I would be in right now. And I continue to expect very large downside to the market. I think $210 of earnings is very likely. And I think a 15 multiple is more than reasonable. That's just a garden variety recession multiple. And that would lead us to a target of 3150 on the S&P 500. That's over 22% lower from today's levels. As of today, May 4th, 2023. So the only way I'd revise all of this, all of my views here and admit I was wrong is if we see a reacceleration of S&P earnings growth. We need to see that happen. Earnings are the most important, determinant of market movements. So if we have a reacceleration of earnings growth, then I would admit that I was wrong and that we need to, start to think that maybe we are in for a soft landing, which is that inflation comes down and we avoid recession. But I don't think that that's possible at this point, given all of what we just saw here today. So again, my ideal capital allocation for 2023 remains unchanged. I would be in 1-year treasuries or less. And they currently, and the 1-year treasury currently pays 4.7%. That's a tremendous deal. You can also buy a money market mutual fund, but I would be sure to only pick mutual funds that have only treasuries and or deposits directly at the Fed. So I would look for, a money market mutual fund that specifically says the word Treasury in its title, such as the Vanguard Treasury Money Market Fund or the Fidelity Treasury Money Market Fund. This means that all they invest in are short duration treasuries, 3 months or less, and repos held, with the New York Fed. That's how they usually do it. So I would look into under the hood and make sure that whatever money market fund you're picking, it owns only one or both of those and nothing else. And then also on the equity side, focus on the Zacks earnings certain portfolio. These are recession resistant, very high quality businesses. I would focus on companies with the lowest beta, companies that have dividend growth and or share buybacks. And here's the kicker, little to no multiple expansion versus their 15-year medians. Because here's the other part of the story. A lot of these companies can be great long-term holds, but if they just go through some multiple compression, then they do have quite a bit of downside. But relative to the market, I think the earnings certain portfolio overall will be a major source of alpha in the coming year. So again, position yourself for a low growth environment with a combination of recession resistant growth, which is our earnings certain proxy, and income, which is 1-year treasuries. So these are the types of businesses that we like to own, high quality companies that have demonstrated recession resistance, consistent growth, very deep moats, tremendous businesses that have entrenched products and services that are always in demand. These are companies that don't make things that are nice to haves. They make things that are requirements for everyday people. And so this is what their earnings looks like. You can see that, over the past 20 years, it's been just tremendous earnings growth and consistency over time. So that is all I had here for today. Again, any questions, I'd love to hear from you. If you have any questions or feedback, if you wanted more information on any one thing, or if you'd like me to address a certain topic in a future webinar, please do reach out to me. I'd love to hear from you on that. If you are a ZRS client, you can reach me at zrs@zacks.com. And if you are a Advisor Tools client, you can reach us at zat@zacks.com. Thanks everyone, and hope to see you again for future webinars.